Hi, my name is George Dagnino, and I'm the editor of the Peter Dag Portfolio since 1977. I read many books of history of interest rates, history of commodities, financial history, monetary history. I'm not a political scientist, but what do I get out of all these books is information about how to understand the investment environment and how to take advantage of it, taking away all the politics that sometimes cluster our view. One of the important things that I learned that very few people mention on the business channels is that the strength of a country comes from its current account balance. If it is a surplus, the country is economically strong, and chances are they have a strong currency. If the current account balance of a country is in deficit, then that country will have problems, and chances are it will have a weak currency. The current account balance is basically a trade balance plus minus financial flows from or out of or into that country. So this is very important. What is a strong country? A country that has a current account surplus. Now you may want to look at this slide a little more carefully later on. Another concept that I learned the hard way is that long-term investing does not exist. Long-term investing is absolutely the wrong idea sold by some people for some reason because they believe they lived 100, 200 years. But most people don't live 100, 200 years. So people have to think short-term. And let me give you an example. Sure, you think about long-term going from 1967 to let's say 2012. But from here to there, you don't have, when you have some money, you don't have the time to wait 100 years to get, or 60 years, 70 years to get some profits from your portfolio. Notice how the portfolio doesn't do anything for 15 years, is not doing anything for 13 years. So you have to think short term. What's going to happen next? Am I going to lose 40% of my value of my portfolio? If you do, it's very difficult to think long term. You have the main idea behind your investment strategy should be to minimize risk and to minimize losses of your portfolio, preserve your capital, and this takes a daily, weekly, monthly focus on your performance. What can we learn from history? Little or nothing. I guess you have to be very careful. I know that history does not repeat, but it rhymes, but because we want to make it rhyme. No one knows the outcome of political, social, or economic decision. No one knows. Think about now. What do you think the political decisions will be 1, 2, 3, 4, 5 months from now? You don't know. History is random. Many philosophers saying that. It is true that sometimes seems to repeat itself, but because we try to fix the patterns that we want. But really, you cannot predict history. And then there is the fallacy of utopia. This is an interesting thing. Again, it comes also from philosophy. What a politician does and what a leader does, it sells you a great idea. It has to prove that eventually will work out, but convinces people to trust them and to trust them no matter what. Look at, for instance, the European Union. For 10 years now, that continent is in a mess. And why? Because people believe in the dream of Europe. And the dream of Europe has created only one thing, a disaster, poverty, recessions for all the people. But again, they believe in utopia. They move ahead, and even if they suffer so much. The other thing that really caught my attention a lot, think about all the people, again, I'm talking not as a political scientist, but think about all the PhDs, all the Nobel Prizes, that the think tanks and the experts that are in Washington. That's the only thing they do is to advise the president or those in power how to run the country. Yet, this country had a major recession in the 20s and the 30s, and really ravaging the country in a terrible way, credit, and yet they had all those people, smart people in Washington, that they missed the whole process there. Think about the inflationary 70s, when inflation soared from 3% to 15, 16%. And during that decade, the country was at war. We had recessions every 3 years, soaring interest rates to 20%, unemployment rate rising. And then, with all the smart people that we had in Washington, then we had finally the go-go years of the 1990s. But then again, more wars, ending with a tech bubble of 2000 that no one believed was a bubble, but created really huge wealth destruction. And then again, just a few years later, the housing bubble, the subprime crisis, the huge leveraging of consumers, and then the great deleveraging that started in 2007, creating very slow economic growth. And the outcome has been that from 1999 to 2012, the stock market has been absolutely flat, little or no growth in the economy and in income, and short-term interest rates that reflected the dismal state of the economy by dropping to 0%. So what did all these people, smart people in Washington, did for us? Did we live a great period of time since the 60s or the 50s? Absolutely not, as you can see. So how can we trust what's going on? The only thing that really I learned, and this is written by Sidney Homer, the great bond strategist, is that interest rates tell you the fever chart of any economy. And this is the chart of interest rates from the 50s to 2012. And here we go from very low rates when the economy was very weak, and then the inflationary 60s and the 70s, high inflation, and finally the disinflationary period, and now the depression level interest rates. So this is really tells you what has happened in this century so far. But there is another lesson here, that the average interest rates, and this is really very important in my view, that the average interest rates through history in any country that has a steady, good, solid growth is around 5%. The further away we are from this 5-6% in short-term rates, the more the country is in trouble, like in the 70s and like now in the 2000s. But really, the only thing that I really found very convincing is after I read the book Why Nations Fail. I always, coming from Italy, I sensed that I had that feeling that already in my heart that this is really what really happened to every country. And is that concentration of power is closely associated with slow economic growth. This is a book showing the history of many countries where this has happened. In other words, when power is closely concentrated in the hands of fewer people, industrial, financials, or bureaucracy, they tend to protect their turf and they don't allow other people to move up in wealth and income because they are concerned that they're going to lose their status. This is a very convincing case, and I could see this with my experiences in Italy and actually my experiences in Europe. And I'm wondering if this is what is beginning to happen to this country. The fact that, for instance, we are growing very slowly. Maybe there is too much concentration of power in Washington. I don't know. But something really to think about it. It is because of all the cross currents from history, from politics, from everything, that in my strategizing for investment purposes, I really keep focus on what's happening now. That's why we cannot think long term. We don't know what's going to happen a year, 2 years from now, 6 months from now, but we know what is happening now. And this is why I focus in my strategy to the business cycle. I know when the economy is growing rapidly, because here in this phase, commodities are rising and stocks that are commodity sensitive are very strong. When the economy slows down, we know that commodities are declining and another class of asset classes is stronger and bonds become very attractive. And when the economy starts improving, commodities bottom out and then the asset allocation changes. So by focusing every day, every minute, every second to the position of the business cycle, I keep my mind clean from all the events that are happening around political events that happen around the world. Well, I want to thank you very much again for reviewing this video. I really hope that this has been useful to you. Is a way, I think, because I'm a market strategist, I'm not a political scientist. I don't understand, I mean, and I don't want to understand politics because it really has little or no meaning. There is no implications for the future. But if you focus on certain little things that are very obvious, like, again, the business cycle, what happens now, then you can develop an investment strategy that has some meaning. Again, thank you very much, and I hope to see you really soon. Okay, bye-bye.